Retirement planning should be more than just talking about investments. You want the confidence to enjoy this special time of your life. If you want more from retirement, you've come to the right place. This is the Marc Oslar Retirement Experience, the financial pathway to more.
And welcome once again to the Marc Oslar Retirement Experience. My name is Randy Cook, and each week Mark and I sit down here and talk about what's going on in the financial news. You see the ups and the downs, the red arrows and the green arrows, and there's been a lot of that lately, and we have a lot to talk about along those lines. But what's most important is what's going on with you between your ears, and how are you feeling about this thing we call retirement, getting ready for it, saving for it, finding that person to help you through it. That's really what we want to home in on this show and every show. Mark is here. How are you doing today, my friend?
I'm great, Randy. It's a beautiful day. We've had great weather recently, and so I'm just excited. I know this is a great time of the year for us to discuss the springtime, right?
Mm-hmm. Oh, my gosh. When I moved to the South, I understood what spring finally was. In the North, when you're from Minnesota, and spring is just black snow and slop, it's just not nice. And I never liked spring, but boy, when I moved to the South, I really started to appreciate what spring was all about. And then I understood what yellow pollen was all about and all that goes along with that. So there's ups and downs of all of it, isn't there?
Absolutely. And I, when I came down here, because I was born in Philadelphia and I was raised in South Jersey, and I came down to Wilson, North Carolina. And that's where I went to a small college called Barton College. And that's when I experienced pollen truly for the first time. And I have never been the same since. Me and Allegra have become best friends.
There's every now and then you go out, and I don't have it that bad. Some people just suffer with it so horribly, but you'll go out and you go, something must be blooming because I am sneezing and it's in my throat and I don't know what it is, but let it get over with because I got to move on. All right. Well, we all want to move on from what we've got going on in the markets right now. Holy cow. I mean, you want to talk about volatility. We are closing the book on April here pretty quick, and it's one of the worst and most volatile Aprils we've seen literally since the Depression. I mean, this has been nuts, hasn't it? What's it been like? Have people been calling, Mark? Are they worried? What are you seeing right now?
Oh, gosh, Randy. Yeah. People call, especially that week in particular when it was April 3rd to April 10th. Oh, my gosh. I did presentations on the 8th and the 10th. And when we got to the 10th, I said, okay, guys, I just want to tell you something. In my 24-year career, I have never seen out of 6 market days 4 that were so crazy volatile. And even now we're experiencing it. I'm looking at it and thinking, what's it going to look like tomorrow? You know?
Yeah, you just don't know. I mean, I'm a big golf fan, as y'all know, and watching the Masters, I saw Rory McIlroy just go from, recovery to setback to recovery, and it was like, this is like the stock market. It's just up and down, and my stomach was going with him, too. And that's kind of the way people feel right now. When is this going to be over with? We may be stuck with it for a while. Now, this is one guy who's on the financial networks regularly. His name is Ed Yardeni, and he's kind of calling a bottom here. He's saying, I think the worst of this is finally over.
Yeah, there's plenty of things to worry about, but the market is actually holding up pretty well. I mean, we're still basically in correction territory. We got very close to bear market for the S&P 500. The NASDAQ got into a bear market for, a few days, and now we're back in correction territory. I think we probably made the low in this sell-off on April 8th, right before the April 9th shot to the upside. I think Americans are great. When we're happy, we spend money. When we're depressed, sometimes we spend more. As long as there's a wherewithal, and the initial claims data show that the labor market's hanging in there remarkably well.
All right, so that's key what he said there at the end. We're going to get into that. But here he is, literally, he's kind of calling the bottom on this. He said the worst of this is over. Since the first week of April, the last 2 weeks of April, they've been kind of crazy too. So, is this something that you pay attention to, Mark, when somebody says that, they call the bottom, and do you move forward or you go, that's just talking heads? What do you say to something like that?
I love having this conversation because I could take a room full of economists and get a different opinion, different sides of the spectrum constantly over and over again. I have favorites that I follow, and specifically for certain purposes behind understanding certain definitions. So One of the things we talked about in the past at some of my seminars as well is stagflation. That's just that combination term that it actually did happen in American history. And folks wonder, how can stagflation happen? It can actually happen when our country, our government, will address unemployment first before any kind of serious problems with regards to inflation. And if that occurs, that's how stagflation could actually occur. I'm not stating that something like that can happen, but I'm saying that it has happened in American history. It happened in 1974 to 1975 and 1978 to 1982. So I like to bring this up. I talk about it in my presentations because I want people to identify certain things in case you see these things actually happen. Just so you know, so you can have the education behind it. Not that it might actually occur, but I bring that term up simply because with the interest rate environment the way it is, with not understanding exactly where we are with regards to normal inflation, and then knowing that our country did at one point address unemployment first.
So that's what he said right at the end, is the labor market seems to be hanging in there. And the reason he said that is exactly what you said, because inflation is too many dollars chasing too few goods. Okay, there's a shortage of goods. People got a lot of money. They pay more. Prices go up. Stagflation is that. And then you add in unemployment. And now you've got recessionary situations and stagflation. So if we go there, that's going to be very difficult for our country. I heard somebody say not that long ago, when all this recession talk is, when we think about a recession, we think about 2008 and we think about 2000. And those were pretty severe. What this gentleman happened to be saying was he doesn't think that this recession, because it was built on policy, because our government kind of triggered it with what it's doing right now with the tariffs and things like that he didn't think it would last as long. What's your take on all of that?
It's, this is interesting too. And I get into this at my presentations as well. We talk about the difference between a recession versus a soft landing, because the Fed truly was trying to create a soft landing. The problem is this, that they rose interest rates 11 out of 16 months. So that's not the steady way to do it. And they did it because they felt like we were definitely going to fall into a recession. Nothing has ever been really truly identified as a definition of a recession based on the time we went through, other than the effects of what we all felt as a country and as an economy, correct? So when we look at this and we hear these things, I identify a lot of things. I don't think we've even achieved a soft landing yet. I think we need to pay attention to where we're at. Randy, do we have to have all our money in the market when we reach a certain age?
No.
No, we don't. Is it logical to? I mean, these are the conversations we have. And are you building, your income based off of inflationary measures and future inflation as well? So these are all the topics and conversations and discussions we have. So for me, I'm not sure, Randy.
Yeah. This is one of the things that people are worried about. We're all worried about, is going into a lengthy recession, because if you look at that market now, and I know that you're probably looking at your iPads, you're looking at your computer, you're looking at your phones, and you're probably looking at it more right now because the market is very volatile, wild swings going on. So you want to say, hey, how am I doing? How's my retirement money going? And then when you see it go down, 35,000, 50,000, 75,000, you wonder, am I going to be able to have the retirement that I thought I was going to have? Or if you're planning to retire in 1 or 2 or 3 years, is the money going to recover from where it was, just a couple of months ago? And this is a real concern. And if that is your concern, now that is a conversation about how much money you want in the market. Let's have that conversation. Give Mark a call. Get a look on his website. Moretoretire.com is our website. If you scroll down to the bottom of the page, there's a place for you to put in a little information, and Mark will reach out to you on that one. Or you can reach out to us right now at 984-300-1984. 984-300-1984. Now, something I also want to ask you about is the idea of bonds, because people have in the past, when the market, goes down, bonds are supposed to kind of hedge that, go back up. And we've had a lot of conversations about where interest rates are. Interest rates affect bonds. And there's a big concern that there's going to be a big sell-off of U.S. bonds. People are losing confidence in our economy and wondering if those bonds are going to be any good. Can you explain what this big concern is right now?
Well, when we talk about the bond sell-off, Randy, we could attack this from so many different levels. We could talk about U.S. corporate bonds, which just generally comes down to the companies themselves, right?
Mm-hmm.
We could also talk about treasuries because, I'll bring up the treasury thing first, okay? Because that directly affects our U.S. economy. There's that threat level out there that based on the whole tariff situation, that China's got it where they might dump a bunch of U.S. treasuries.
Okay, so they have a lot of our debt, right? Correct?
Yes.
Okay.
Now, folks say, oh, but that's only a fraction of the debt we have out there.
Mm-hmm.
Yeah, but it's a pretty nice fraction.
Okay.
And if that happened, there could be a massive effect upon that. Now, when you hear stuff like that, how does that affect our companies, corporate bonds, and are people going to sell off? Well, here's the thing. If you got into bonds at the time where interest rates were at the all-time high, right? And I'm not saying all-time high. I'm talking about within the last 10 years.
Okay.
So let's say you get in. Well, that's beautiful. They got this high interest rate, right? But then at the same time, the high coupon rate. Well, then we look at it and we say, well, then what's going to happen when interest rates go lower? Those are going to be really attractive and people are going to want to buy them and they're going to be worth a lot more. Most people did not get in at the high. And right now, we don't even know if we're going to hit another high or if we're going to go lower. We haven't figured this stuff out. And with the uncertainty of the economy, it affects the U.S. bottom line. So if you see equities being affected by this, you're going to see the bonds being affected by this as well. With inflation not being able to be predicted by anyone right now, there's a lot of uncertainty.
Yeah, there's a tug and pull right now going on between President Trump and Jerome Powell. Those two are kind of going back and forth on, lowering rates, hiring rates, all that kind of thing. And I laugh when he wants to fire him because you know who hired him? Donald Trump.
Yeah, well, it's kind of ridiculous because he's not going to fire him.
No,
I don't even think
he can't.
He can't.
Yeah,
that's the point.
He's got to resign if he's going to get rid of him.
That's exactly right. And the other thing is, Randy, let's just talk about that for a second. Jerome Powell is not going to lower interest rates until he sees that CPI tick down or at least be a little bit more even. But year over year, it keeps happening, keeps ticking up. What are we going to do about that? He can't lower interest rates like that.
Yep, I've heard that as well, and I'm starting to hear that even on Fox Business. People saying, you know what, love the president, but I disagree with him on this particular point. We should not be moving interest rates right now. Well, there's a lot going on out there, and there is a lot going on between your ears. There's a lot of worry going on. There's a lot going on with your accounts, and this is that kind of time when you go, am I going to be able to retire? And can I do this the way I want to? And if you don't have that person in your life that can analyze those numbers, take a look at what you have, what you've done, what you've saved, and where it's placed, we really need to have that analysis. We will do that for you with Marc Oslar. Give us a look on our website, moretoretire.com. Pretty simple right there. Moretoretire.com. Just spell it out. And at the bottom of the page, there's a place for you to put a little information in there. And then Marc will reach out to you and say, hey, what is it that you'd like to talk about? Maybe we can help. Or you can just call us, reach out to us that way. 984-300-1984. 984-300-1984. Well, I've heard it over and over and over doing the show like this, that there's a retirement crisis in this country. We're not saving enough money. And then I came across a headline that says, you know what? I think we're saving too much money. Why would that be? Well, new research says that if you've saved about $500,000 for retirement, a pretty common number, and after 20 years, how much of that money do you think you would have spent? Probably quite a bit. But according to the research, only $60,000. That's how much people have spent. So they came to the conclusion, we're saving too much. But when I look at that, Marc, I see something else. I don't think we have a saving problem. I think we have a spending problem. I think that we're not going out there and enjoying our retirement the way we should. I think we have a confidence problem. What do you make when you see something like this?
It varies. The clients of mine that have large portfolios, and when I say large, quite large, they usually don't have that same problem. For the average client, and you're talking about a portfolio of probably around $1 million, right? Yes, I would say them, and on average, those people have a spending problem. They're afraid to spend. They're afraid of their money running out. I'll give you an example. I had some folks that came to see me with the concern of being able to retire not only at 62, but even at 65 years old. And so the concern is real. But we're going to figure it out. We're going to get answers for them and help them figure it out. And you can't rely fully on Social Security in these situations because of the problem that hasn't fully been addressed yet. We know that since that hasn't been fully addressed, that the trust fund could run out by 2033, and it could affect people's Social Security minimally by 20%. And this is a real problem. So when we talk about that, and then we associate it with another case that I'm working on with some folks. These are clients of mine that they're kind of stuck in this annuity product, and I'm trying to figure out how I can get them out and get them into a situation to make more money. Mm-hmm. Well, at the same time, I'm looking and analyzing their situation and realizing that with the surrender charges, there's just no way I can move them into a lifetime income rider because there's not a big enough bonus to bonus them out. It won't be suitable. Suitability is a big thing, right? So we're trying to figure out, okay, if that's not the case, can I bonus them to a product that actually is making more money than what they're making right now? They're only averaging about 1.5% per year, which is terrible. And I said, this product doesn't even exist anymore. How do we move you out? I found a product. The number one thing I look at when I see these situations, Randy, how can we get you to spend with confidence in retirement, but maybe not overspend? And these are the discussions of real things we have. We talk about vacation. Do you want a vacation? Do you want to go on certain trips when you first retire? Because when you get in your 80s, you're not going to feel the same way as you do in your 60s or 70s.
Right. And one of the things that is so common is people get into retirement and they've spent their whole life saving, and then they got to get into a mode of, now I can finally spend this, and it's hard to make that jump. It's hard to go out there. All of us have, like, you buy a car, you have buyer's remorse. Oh my gosh, now I got a $500 payment. Or you buy a house and it's like, oh, now I'm going to be house poor. And you have some of that buyer's remorse. And maybe you're a really good saver. And people like that, people like us, we have a hard time moving into that spending mode. And that's one of the things about having a financial plan, having a retirement plan to give you the confidence that you're going to go out there and you're going to empty that bucket one month and it's going to be filled up the next month. That's the kind of confidence that you want. Give us a call. Let's build that for you. Let's sit down and look at your situation and customize a plan for you. MoreToRetire.com is our website. Maybe it's just a conversation right now where you're worried about markets, you're worried about Social Security. Let's talk through it. 984-300-1984. 984-300-1984. Now, the word annuity comes up a lot. Some people love them. Some people don't. Some people, who have them think they're the greatest thing. But others, they're a little questioning right now. So the thing about it is all these baby boomers retiring, they've been setting records over the last couple of years of people using annuities. They like the idea of the income, replacing the paycheck, that whole thing. Then the question is, when should I purchase an annuity? We tell you to come in a couple of years before retirement. Is that when you should do it? Or right on the edge of retirement? This is Elizabeth O'Brien from Barron's, and she says, go ahead and wait.
A good time to buy if you're going for a fixed annuity is right when you need it. In retirement or approaching retirement, you calculate your expenses. You say, okay, I want my essential expenses to be covered by Social Security or an annuity. That's a common thing. So here's how much I need. Let me go buy the annuity. You don't sort of buy it way in advance.
So I've heard pros and cons both ways. Mark, how do you sit on this? Should somebody set themselves up with this and let that money percolate for a while? Or how do you do it?
Well, I highly disagree with the advice just simply because everybody's situation is different. Mm-hmm. You meet folks where there's people that I meet where they have a lot of money in annuities and then the rest of the money in the bank because they don't want any money in the market. And if that's your risk tolerance, I get that. Let's have a conversation. Let's see what you've gotten into. Some folks have gotten into annuities in 2019, 2020 when interest rates were low. And because of that, some of their rates, some of the caps, some of the participation rates, some of the indexes didn't work out. But now things are in a place where they're at an all-time high. I've never seen bonuses as high as they are. There are ways where we can look at these contracts now that you couldn't look at before, and I can give helpful advice. So I would say this. If you have money in the market, all your money in the market, you haven't done an annuity, but you're interested in understanding the purpose behind the annuity, not just a fixed annuity. We're talking about fixed index annuities. One's also with lifetime income riders. One's maybe with living needs benefits. There are specific long-term care annuities out there that you have to be long-term care licensed for, which I am. We can have all of these discussions. And then with regards to your market money, we can talk to you about what we do. We work with a group called Market Guard, and they can do some things that other folks can. I'm only one of 300 advisors in the country that can do stuff with Market Guard. So let's have these real conversations now. If you got 5 or 10 years before retirement, fantastic. Come on in. Let's have a conversation. My appointment's free. I don't charge for advice. There's only a couple of ways that I make money. I make money based on fee-based advising. And then if you do any kind of insurance product, that's always commission related. Now, with regards to a fiduciary standard of care, it applies to our what we do as a whole in our business, but in terms of how it applies towards the brokerage side of the business.
Mm-hmm, mm-hmm. So when we talk about coming in early, is it an advantage? Tell me the pros and the cons here. Is it an advantage if I'm 3 years away from retirement? Mark, I don't need income until 2028. That's when I need my income. And so is it good for me to purchase an annuity right now and the insurance company holds that money and invests that money, and then when it comes time for me to use that money, I get paid? Do I get paid a higher amount if I wait a while? I know there's something called an immediate annuity where you can, purchase it and then 90 days later you start getting paid, and that might be at a lower rate. Explain to me how that works.
Yeah, in immediate annuities, they used to pay the most in terms of the payout structure. And now what we're seeing now are the deferred annuities with the income riders are actually paying at higher percentages. And so you can get money in as little as 30 days if you wanted to turn on an income rider, if it made sense, if it was something where you just wanted to guarantee a certain amount of money for the rest of your life. And with an income rider, it's deferred in the sense that as you take that income, you don't lose the money until it's completely out. So it's a little different than an immediate annuity. So with that, we take this into account. If you got 3 years before retirement, let's come in and have a conversation. Mm-hmm. We might sit down and see this portfolio and say, oh, you got this $200,000 Roth IRA over here. We might be able to commit this towards the percentage for a lifetime income rider. We might pick something to do a growth type of annuity that's a fixed index annuity, but still safe. Then we might put like $500,000 in brokerage, depending on your risk tolerance. There's a lot of things we like to do, but we like to attack it early because we can get an idea of what we can do for you in 3 years much better than when you come in and say, what can you do for me now?
One of the things about coming in early is we can maybe work on some things that would be helpful, maybe work on some debt, work on developing income and getting you set for that retirement date. It can really be an advantage to come in early so we can help you work through some things. Let's have that conversation. Maybe you're looking 3 years from now or 5 years from now. You don't have to come in, 1 month before you retire. We'll help you for sure, but there is some advantage to coming in just a little bit early. Give us a call. Give us a look at our website, moretoretire.com. Moretoretire.com. Scroll all the way down to the bottom of the page there, and Mark has a place where you can fill in a little information, and that way he can reach out to you and say, okay, what is it you're concerned about? How can we help? And start that conversation. Or just give us a call, do the same thing. 984-300-1984. 984-300-1984. So we talked a little bit about the tariffs and things like that, and they've had a negative effect on the markets. We've been really bouncing up and down. We're down I think 16% from our February high and even more. And the question is how are you taking this? How are you reacting? Did you move any money? Did you make any money moves? Vanguard says only 8.4% of their investors did anything. Their buyers outnumbered their sellers 5-1. Overall, yay, we're not panicking. So that's a good thing. The question is, Mark, how are your clients reacting? Is this a time to move money? Does that put us in that market timer situation? How do we react to times like this?
That is a fantastic question. And, where we start with folks is looking at their brokerage statements. So we ask to look at your brokerage statements, your 401k. We plug in the numbers and we run a report and we identify what your current standard deviation is. And that relates to your level of risk. And then we try to identify if this standard deviation really is your level of risk, because we want to understand if this is going to be okay moving forward. Then what we want to do is identify correlation. So if people aren't panicking, that's a good thing. Because if they start to panic and you're highly correlated, there's a very good chance that you're going to drop as the market drops. Okay.
Now, before you go any further, we're going to take this out of financial ease here just a little bit. So standard deviation, to me, that means how much wobble is there, right? So
Yes.
if it's at 0 and it goes up to 5 and it goes to -5, that's the wobble. But if it goes to 15 and it goes to -15, that's a lot of wobble, and people might not like that. Am I right there?
That's exactly right. And
Okay.
let's say, for example, we're looking at Market Guard and they have an equity model and the standard deviation is 16%. They also have scientifically figured out what the max drawdown is going to be, and that's just telling us in any horrible situation where we shouldn't lose more than, okay? So all of this stuff is important. And we want to identify this because why? The last 2 recessions lost 49% from start to finish and 56.5% from start to finish. Okay. And I don't want to see anybody drawing a line from 2000 to 2013 across the S&P 500 and not making anything for 13 years. I'm not saying we're headed for 2 different recessions that are pretty massive. What I'm stating is you don't want that type of volatility in retirement.
Gotcha.
The question is, how much money do you have? And so, yes, under identifying standard deviation and correlation is very important when we're talking about standard deviation because that has a lot to do with whether you're going to lose that money or not and whether you're going to participate in all those market gains or not. We can break that stuff up. So when you want to break up correlation or you want to lower the standard deviation as a whole, we can build in other things like structured notes. And then the insurance products, of course, like annuities, those types of things, that'll break up your correlation and lower the standard deviation if we're looking at it as a whole as well. So essentially, we want to do is find out how we can answer your questions. That's why we start with a report.
All right. So when you talk about the market, let's just use some round numbers here. Say the market goes down 10%. I look at my account and it goes down 10%. If we want to adjust that a little bit and work on that standard deviation, that wobble, and say, my money, even though the market goes down 10%, I only go down 5% or I go down 3%, I'm a lot more comfortable with that kind of a swing than I are with the massive swings that we're seeing in the market right now.
Absolutely. When you're talking about from high to low down 16%, some folks are only down about 7%. And that does matter. It does matter in retirement, and it does matter if you're taking withdrawals. I mean, I met somebody where they had all their money in the market. They're highly correlated. They have a high standard deviation. They really do not want all that risk, and yet they're also taking withdrawals from that money at a 3.5% clip. Well, when these types of things happen and you're withdrawing the money, it can be have a drastic effect on your overall bottom line. We call it the double whammy because when you're taking the withdrawals and you're getting hit with that, it can be very difficult because your money goes down a little bit more. And when we talk about this, we're discussing specifics about, let's just say numbers in general. So when we talk about numbers, and let's just talk about sequence of numbers, Randy. If we have losses in the market and gains in the market over a 10-year period of time, if we use the same figures for column A and column B, but we mix up the pluses and minuses, the years they happened for column A versus column B, at the end of 10 years, the numbers come out the same for the returns. But if we mix in withdrawals and we adjust the years that they occur, they can come out much, much different. And I don't want people to experience that in retirement.
So we're going to be armchair financial advisors here because I know I'm looking through the radio right now. I see you out there because you're getting ready for retirement. You're a couple of years away. You've got a 401k and you know that you can go in there and tinker with that. You can mess with your allocations. It could be a 50-50 or a 60-40 or a 70-30, whatever it is, stocks to bonds or stocks to cash, however you do that. And this is what people, the temptation, Mark, is that when the market does this, you go in there and you change your allocation so that you don't have as much in the market. And then you hear the guy that we heard at the beginning of the show who says, we hit the bottom. And then you go in and you tinker some more, and the temptation is to say, okay, if the market's going to go up, I'm going to smooth this thing over to 80-20 or 90-10, and I'm going to really make it on the upside. That's what people do, but they can get burned doing that, can't they?
Oh, yeah, absolutely. We have to figure out exactly what is the best fit for you. So if you just think it's bottomed out, I got news for you. We just participate in the market. We're not making the market. So anybody that makes those comments, I mean, do they have insider information? Because I certainly don't want access to that. It's illegal in the first place.
Right.
Okay. But yeah, truly, it's a guesstimate, right?
Yeah.
We like to combine that word. But truly, Randy, let's just figure out how we can put you in a position where my goal, Randy, when people meet me and we get to know each other, is I want to help. That's the number one thing. I don't care about anything else except for, can I help? And then to what level would you like me to help? And then on top of that, I want to give power back to you, because I know there's a lot of you out there that have worked with advisors and you feel like you don't know what you have, don't know what you did, or they might not be answering your questions like they should. Well, I'm ready to give the power back to you.
I think that game that I just described of the armchair financial advisor, where you're, moving your 401k money around, risk, no risk, and trying to figure out when to get back in, doesn't it make more sense to sit down with Marc and come to an agreement as to, here, I'm comfortable right here, whether the market is really high or goes down really low. I know that I'm going to participate in some of the up, and I'm going to participate in some of the down, but not all of it. And I think, Marc, when you talk about the correlation, we all think about diversification as I've got 17 mutual funds. That's not it. It's what's in the market and what's out of the market. And we got to have our fingers in both those pies, don't we?
We do. And I'm so glad you brought that up, because when we run the report, it's a stock intersection report. What it does is break down your mutual funds, your ETFs, and how they're allocated towards particular stocks. And then it can also identify, are we too highly correlated to the Magnificent Seven, for example?
Okay.
And it happens often. I mean, often. So you think, I'm well diversified. Well, let's find out. I know you said that, but let's find out, because I think we have an answer for you.
You think about all those funds that are in your 401k and the ones that are doing well. I'll bet, Marc, if you dive in there, you're going to find that the ones that were doing well over the last couple of years all kind of got the same thing. They've got that Magnificent Seven in there. They've got those energy. They got Exxon. They got all that stuff that was going up. But at the same time, now we're seeing those same stocks go down, and look what's happening to your money. It's going down, isn't it?
Yeah, I mean, let's talk about emerging technology, right? I mean, that's the one that shoots up and then also comes down. I mean, it'll affect that portfolio. So if you're, highly correlated to that in particular, yeah, you probably got hit harder than the market did.
Well, we would love to do an analysis like that for you. Wouldn't you like to know where your money is, how it's doing, what is holding you back? And when times are tough like this, what is it that is hurting you, and how can we help you? You don't want to go through this in retirement. You don't want to have these wild swings, because then you're going to say, oh, I guess we can't go on the trip this year. The market is down. That's not where you want to be. Give us a call. Let's talk through it. Look at our website, moretoretire.com. Start there, moretoretire.com. At the bottom of the page there's a place where you can put a little information in there, and that's simply from Marc to give you a call and say, how can we help? As he said, how can we help you with whatever you're concerned about? You can skip that and just go to the phone number if you want. It's 984-300-1984, 984-300-1984. Well, we've moved our way out of basketball season. We aren't really talking football right now. Now we're talking baseball. So I'm going to talk some hot dogs here, ladies and gentlemen. All right. Who sells more hot dogs each year? Costco across the nation, or all the major league ballparks combined? The answer is Costco, if you can believe it. They sell about 100 million hot dogs a year. That's insane. And I know they're still like $1.50, but I want to point something out. If you want to go to Costco and get your $1.50 hot dog, you got to pay a membership fee to get in the door to get that hot dog. If you got a hankering for a hot dog at a ballpark and a beer, you got to pay a ticket to get in there to do that. Now, why am I saying that? Well, in the financial world, if you want a stock or a mutual fund or some kind of financial product, there's usually a price to pay. And Mark, the financial industry isn't really good about, holding that up on a placard and saying, this is what this is costing you. They're supposed to be transparent, but a lot of times you got to dig through a lot of information to find out what you're paying. Is this a part of your analysis to find out what's going on and what it's costing people when they bring it to you?
Of course it is. But you're speaking my language here, okay? I mean, hot dogs for real. Oh, yeah. Let's give them a couple of nicknames over here. We've got tube steak. We've got nitrate stick. No, truly. I mean, being from Philadelphia, going to Philadelphia Phillies games, oh, my gosh, I had to have a hot dog every single time.
Yep.
It's very rare that I go to any kind of game and not have a hot dog. It's just a part of what I do.
It's just part of it. Yep.
And we go to Costco, and I feel like I have to have a hot dog when I go to Costco. Why? Because they have this quarter-pound hot dog and a drink for $1.49 or $1.50, whatever. It's right there. I mean, come on.
You got to do it.
It's a great excuse.
You got to do it.
It's important, Randy. So, yes, we want to know the cost of everything. We want to know what you're facing right now, what you're spending money on, what are your monthly expenses, not how you're helping people in addition to that, but your true monthly expenses. Because then we can identify what are your future monthly expenses. Are you going to retire early? You're going to retire before Medicare kicks in? You're going to be able to make less income to the point where you're in the marketplace for health insurance? Who knows? These are conversations we have because if we have them now, we can identify what you're facing in the future, and then we can help you with the answers for your expenses or your expenditures. And you know what? When you retire, let's just make some places and pools of money that you can pull for those trips you want to take too. These are the real conversations we have. We want to identify your real expenses because I have had clients tell me what their expenses are. We work it out, and then we have to rework the income a year later. But I tell them, look, it's not we're a work in progress. We're just trying to figure it out as it comes. What I can say is, why don't we pull out the uncertainty in it and get some more certainties for it? So let's use some preservation tactics, right? And let's look at, hey, can we build some annuities into your portfolio where you don't have to have all your money in the market? Do you need an income rider? Do you not need an income rider? What's Roth? Do you have Roth money? Do you want to do some Roth conversions in retirement? Oh, do you want to contribute more money? Do you have 10 years or more work left? I talk about the life insurance product where you can invest in a life insurance policy, stay under a modified endowment contract limit, and you could potentially have withdrawals and tax-free loans from that policy in the future that far outweighs what you can contribute to a Roth IRA. And then if you make too much money for a Roth IRA, you can contribute to an IRA and convert it to a Roth as a backdoor Roth. We can talk about every one of these things. Randy, these are all in my head all the time. So I'm ready for you. Come on in, meet me.
Well, we all want to know what life costs us. And maybe you're a spreadsheet person, you do your bills online, and you know exactly what you spend every month. You got it all lined out. But now when you say to yourself, I got to think 10 years from now, 15 years from now, 20 years from now, what are my expenses going to be? How much are my investments going to cost me? What are taxes going to cost me? It's hard. It's really hard to do that because we don't know what we're in for. I mean, think of 20 years ago, what you were paying for then, and 20 years later, what you're paying for now. There's a lot of stuff there that wasn't even invented 20 years ago that we're paying for all the time now. So that could probably be a part of your retirement budget. So let's talk through that, and let's get that all lined out for you. Here's our number and our website, moretoretire.com, moretoretire.com, or 984-300-1984, 984-300-1984. All right, according to Money Talks News, we've been talking about what retirement is going to cost you. These four things are going to take up about 75% of your monthly income: housing, transportation, food, and health care. 25% left for all the rest of it: taxes, clothes, gifts, grandkids. That should take a lot. And there's no fun bucket here, Mark. There's no fun bucket here. They didn't say anything about the fun bucket. So let's talk about the whole idea of budgeting and figuring out what you spend per month. And the one thing people want to do is have some fun in retirement. I would think that would be near the top of the list, but I know that we have to figure out the daily expenses first, don't we?
Absolutely. And one of the things that doesn't come up is, date night, going out on a date and spending some money here and there. I mean, it adds up, okay? And going to dinner and a movie and then other expenses. Randy, people never bring this up. And I'm like, listen, guys, let's talk about this, because one of the big ones, gifts. I'm sure you're buying gifts for people. I'm sure you're buying gifts for people throughout the year. Have we built that in? And so when we look at it, we want to come up with a total of the unexpected expenses. That's what we call it, the UE, the unexpected expenses. We use that and we diagnose it, but I ask all of those questions because I want to identify, are we giving you the proper advice? You don't want to get bad advice, right? Well, I need enough information at my disposal to tell you about those things. So if you give me enough time and enough information, I can answer those questions for you. And then kids and grandkids. I was talking to my daughter Finley earlier, and she's like, "Oh, Dad, I really want to be on the radio." I said, "I'll get you on there one time, but I'm going to name drop you. Finley, there you go." So she was talking to me about wanting to be on the radio, and I've had some conversations with her in the past about some different things, and we were talking about expenses because I showed her when she was little. She's 12 now. I showed her when she was little. Guess what? Look around you. Everything costs money. Mm-hmm. And they don't understand that when they're kids. So when you have grandkids, I'm sure you're going to want to spend a little bit more too. I hear that having grandkids is way better than having kids.
It's fantastic. It's fantastic. Get them all riled up, sugared up, and then go home and let mom and dad deal with it. That's exactly right. When I think about, and I've gone through this process of figuring out what I spend per month, and Julie and I sat down and we did all that. It's amazing the things that you don't think about. I mean, subscription services like Netflix and Hulu, and then you think of a health club, and then you think of the bug man who comes out once every 3 months or twice a year, whatever like that. You've got the lawn service that comes out, and you do all these different things. And all of that stuff adds up, and it's stuff that's not top of mind. You're thinking of your power bill and your gas bill and all of that kind of stuff. But when you really start to line it out, it's probably the difference between $6,000 a month and $8,000 a month. It can really move that number up, can it?
It can. I mean, I just went to the store the other day because I realized, we need some new air filters for the house. So got some new air filters. And then I turn around and realize, you know what? I'm the bug man at home. So I'm going to go spray ortho around the house. So I got to go buy some ortho. Gotcha. And then I had already used up all my Roundup because it was such a heavy weed year. I needed to buy some new Roundup, and it's going to rain, so because of that, I was going to spray and spray right before the rain and do those things. And then by the time you look around and you count all this stuff up, you're getting like $70, $80 and stuff. Yep. And you're thinking, okay, but guess what? After I spray the Roundup, what am I going to do? I'm going to buy a bunch of mulch. Hey, that's not cheap stuff either.
I know it.
I mean,
it's crazy.
You just start thinking about this. And that's why the unexpected expenses have to come in, and then bucket list stuff. So where do we pull from bucket list stuff? The special category, the special bucket we want to pull from to do the things we want to do. Let's plan on all this stuff.
Yeah, this is that time of year in the springtime where all the festivals take place. Everybody's out with the arts and crafts festivals and the music festivals. I talked to a dad the other day. He says, I just got back from the festival. We spent $200 in food and crap. Just playing games and all that. And it happens. And that's the kind of stuff you don't think about that you really do need to have a conversation about when you're building your retirement budget. I hate the idea that you're going to walk around with one of those trucker hats on that says, I'm on a fixed income. That is not a good retirement. I don't want that for you. I want you to be able to have confidence and enjoy your retirement. Give us a call. Give us a look on our website. The Marc Oslar Retirement Experience, it's moretoretire.com. Very simple, moretoretire.com. Down at the bottom of the page, there's a form fill there. You can fill in a little information. There's even a box there to tell, what are you most concerned about? That'll give us kind of a clue as to what you want to talk through. Let's get these issues a solution for you. Give us a call, 984-300-1984. 984-300-1984. Well, I saved this kind of story for the very end of the show, but it's really very important. I'm looking through this article here, and this is in Bankrate, and it says people try to figure out how much they need to save for retirement. This one CFP says this: there is no such thing as average anymore. Now, not when it comes to savings, not when it comes to lifestyle, and definitely not when it comes to retirement. Every single person needs to take a different path and a different pace to retirement. No single retirement calculator formula will work. It has to be customized. And Mark, that's what you do. Sitting down, this is not a cookie cutter thing. This is not a big company's, I have a place at a strip mall with a big nationally recognized name on it. You are working with people on a one-to-one basis, building retirements one at a time.
This is fully customizable. Mm-hmm. We want to make sure that your experience with the Marc Oslar retirement experience is the right one. And so I take everything we talk about serious. Oh, we still have a good time. We laugh, we joke. I like to pray with my clients too. All of this matters, okay? But I'm serious. I want to make sure that when I have all this information in my head and we crunch numbers and we're running reports, that I'm giving you what I feel like is the proper solution at that moment in your situation, because we do things over time. But it has to be to your level, what your needs are, and everything else. When I get people that come in and say, oh, my friend's advisor is saying, don't do this, don't do that, I'm like, okay, come on in, let's talk about it, because that's kind of a loaded comment, right, Randy? I mean, we want to make sure that that's pertinent to your situation.
Yeah, you're going to see other people retire, and you're going to watch what they do, and you might see them struggle. You might see them not doing very much, or you might see somebody who's really successful, and my gosh, every time I look at their Facebook, they're in a different country, and you're going, how do they do that? Well, they have a retirement plan that's got a nice travel budget in it, and maybe they've done really well in life. Well, why don't we sit down and build something like that for you? If that's what you want to do, let's figure out how we can do it. Give us a call. Give us a look on our website, moretoretire.com. Again, moretoretire.com, or give us a call at 984-300-1984. Mark, when they go to the website, they're going to see the pathway to more. And there's 5 steps there. And this is what you bring your clients through. Just kind of walk us through that. When people call, give them an idea what they're in for.
When you go to the website, you go to our process, you click on that, you'll see the process guide. It's 5 steps. I only describe step 1 and step 5 because I want you to read everything in between, but I'll describe how we go about things. So in the beginning, it's a treetop view. You might do one of 2 things. You might say, okay, I've got brokerage money, 401k money, and stuff like that, and in this treetop view, I want to bring it to you. Perfectly fine. If you want one step ahead, I have a secure upload button on the top right corner of my website on the homepage. If you click on that, you can securely upload that information and send it to me ahead of time. We could schedule an appointment, and then we can run the report for your first appointment. So you're going to get a report either on your first or second appointment. And that's going to be in our treetop view when we look at everything as a whole and we diagnose some things and ask you a lot of hard questions. And eventually, over time, as we build things and as we grow and you become a client and we work together, the last step is ongoing support. We're here for you. We want you to call us, text us, email us, and let us know what your needs are, because we want to be there to help you.
You know, I don't know if you've ever had an experience. I've done this a couple of times in my life. You know, somebody conned me into going to some clay pot thing, and we're gonna make clay pots. Whoopee! and so it's kind of like taking clay and just kind of molding it and keep working at it, and you kind of keep working it and keep working it and keep working it until you get it to that place where you say, that's it. That's the spot. That is the thing that I want to work with. And I think with retirement planning, that's kind of the same thing. There's no hurry here. I heard somebody once say, it took you 60 years to get here. We don't have to do this overnight. It's okay. There's no big rush here. So let's take our time and let's work through it, because there's so much to talk about, Mark. There's the investments, and the investments start talking about Social Security, and then that starts talking about Medicare, and then that brings you to taxes, and that then brings you to estate planning. And I mean, the dominoes just keep clicking on their way down. There's a lot to go through, so let's be thorough and let's get something that you're comfortable with.
100%, Randy. I want to make sure that you have the right experience when you work with us. So as we take you through the process, it brings up so many other questions. Tax planning strategies, things like that, estate planning. We have the attorneys that do all of these things that we can do in addition to just the retirement planning, the brokerage accounts, what's the state of the market, have we planned for inflation, every bit of these things, Randy. These are the things we talk about, discuss. I want to get some good answers for you, but mostly, Randy, I want to help.
We want you to walk into retirement with confidence, and so that you know that you've worked this all these years and you can spend your money confidently, that there's going to be more coming. And that's the whole idea here of a successful retirement. Give us a call. Let's start the conversation. Here's our number. Here's our website, moretoretire.com. That's moretoretire.com. Go to the bottom of the page, fill out that form, fill down there, and Mark will reach out to you. Or give us a call at 984-300-1984. 984-300-1984. That is all the time we have on this one. We thank you so much for listening, and we'll get you again next week here on the Marc Oslar Retirement Experience.
Thanks for listening to the Marc Oslar Retirement Experience. To schedule a meeting about your retirement and the financial pathway to more, go to moretoretire.com. That's moretoretire.com.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.